Welcome everyone, and thanks for taking some time out today to learn more about funding your R&D. I'm Stuart Reynolds, CEO of Full Stack Advisory. I'm here with our R&D Chief, Jack Dean. Now this is the R&D Tax Incentive How It Works webinar, and we've run this for quite some time with the Spark Festival, and we're always proud to help founders fund their innovation with government support. If you're like most founders, the usual process of claiming the R&D Tax Incentive is a bit onerous and powered by a lot of legislation. That's where Full Stack is here to help. Now, to streamline the process, we'll be sharing a lot of our learnings with you today, complete with examples and some insider tips into this generous program to help you get the most out of your claim. So over to you, Jack, to tell us how the R&D Tax Incentive works.
Great. Thanks very much, Stuart, and thank you to the organisers of Spark Festival. It's been really great so far. So I've been with Full Stack for a little while now, and previous to that I was at one of the leading boutique consultancies here in Sydney, and at a global accounting, spent some time at a global accounting firm, our lead R&D tax consultant. So if you have any questions, feel free to pop those in the Q&A or the chat, and I'll address them either as they come or towards the end in our Q&A session. There's also a link there on that first slide, fullstack.com.au/spark, where if you have more questions that we don't run out of time today to answer or are a bit more technically complex, you can feel free to organise a time to speak with myself and Stuart there. And we're also offering a $500 discount for any Spark Festival attendees who contact us through that link. So I'll get it going. Now, the R&D Tax Incentive is the Australian government's flagship program to incentivise research and development activities in Australia. It's broad-based. It's relatively easy to access in terms of the administrative process. So it's a great way for the government to support a range of industries who are conducting R&D that are trying to develop new or improve technologies, processes or services. And they do that by providing a number of quite generous R&D tax offsets, which will either reduce your tax payable or provide you with a cash refund if you're in a loss-making position. Effectively, what that does is allows you to stretch your early investment dollars a bit further and try and navigate that valley of death, and improve your chances at a successful development and commercialization. So the actual benefit for startups is so if you're under $20 million turnover, aggregated turnover for a particular year, you're eligible to access the 43.5% refundable tax offset, effectively giving you a cash back on your R&D activities if you're in a loss position. What receiving an R&D tax offset also assists you to do is it gives you some points to push you closer to the early stage innovation or ESIC status that can give your investors some quite generous incentives to invest in your company or business. I've got a few examples to illustrate the mechanics of the program, because they do differ depending on your tax position. This first example is a pre-revenue venture, eligible expenses of $85,000. They have sufficient losses to fully absorb the add back of R&D expenditure, which means that they can expect to receive a refundable tax offset of that full 43.5%, so 36,975. And so they'll get that as a cash refund. The second example is a company that is making a bit of money. So they're into the commercialization phase, assessable income of $750,000, R&D expenses of $450,000. Because they are in a tax paying position, they don't get the full 43.5% back as a cash offset, as a cash refund. What it does is reduce their tax initially to zero, and then the excess is available as that cash refund. So in this, based on these figures, they could expect to receive $44,500. So still good, reducing the tax to zero and then getting that cash back, allowing them to further invest in R&D activities or spend the money on whatever they want. The third example is just to illustrate for the larger companies, probably not too applicable to anyone here today. For companies with aggregated turnover of greater than $20 million, they get a 38.5% non-refundable tax offset, which just means that it reduces their tax payable. If they don't have any tax payable, it can't be used to receive a cash refund, but it can be carried forward to reduce future profits, or the tax payable on future profits. Now, the most important, or one of the most important pieces of the puzzle in applying for the R&D tax incentive is first establishing the eligibility of your activities. There is a concept called a core R&D activity. You must have at least one core R&D activity in the year, and that will enable you to access the program. The definition is enshrined in the legislation, and there are a number of requirements that kind of work together to establish whether something is a core R&D activity or not. I'll just run through those quickly. The first is that the activity must be conducted for the purpose of generating new knowledge. Now, that knowledge can be in the form of a new product, process, or service, or in the advancement of a particular area of technical or scientific understanding. The second requirement is that the outcome of that activity could not have been known or determined in advance on the basis of current knowledge, understanding, or experience. So really what those two mean together are that you are trying to develop something new or improved. You're trying to do something faster, trying to do something more efficiently, trying to do something just that's brand new. But the path on how to get there, how to enable you to do that, is not known. You can't just go to a reasonably competent professional and have them go, yep, we'll just fix that up for you, and there you go. There must be some kind of technical risk associated with traversing that knowledge gap. Those two kind of lead into the third and the fourth on the next slide here. So once you've established the knowledge gap and what the technical or scientific uncertainties are, the only way to navigate that is through the conduct of a systematic progression of work based on the scientific method and involving experimental activities. And if you're familiar with the program or you've looked into it before, you've probably heard the words hypothesis, experimental steps, logical results, and conclusions being thrown around. Now, a hypothesis for, I'm sure a lot of people here today are in the tech software kind of space. You don't necessarily talk about having hypotheses, but really what that is just a proposition about the interaction of variables, one or more variables, to give a particular result. So we as expert tax consultants will kind of help you navigate that legislation and that wording and take what you do in those R&D activities and kind of apply the legislation to them to really streamline that process. Now, there's some other requirements. It is an activity-based test, so the activities must be conducted in Australia. There is an exception if the only reason why you conduct activities that are outside Australia, you may wish to go down the path of applying for an advanced overseas finding. In that instance, you would have to demonstrate that the only reason you went outside Australia was because you were unable to do those activities in Australia. So if the expertise wasn't available in Australia, or you needed access to a particular population or a piece of scientific equipment, then you may be able to claim overseas expenditure, but there is a process involved there. You must spend, or you must have notional deductions of at least $20,000 per year. It is a yearly process, so you need that $20,000 per year. Generally, only companies are eligible. There is one slight exception there. If you're a body corporate acting in the capacity of, for a public trading trust, but generally only available to companies. And these two final on this slide, the control of the IP and the expenditure at risk, those kind of work in unison to along with the requirement that activities must be conducted for you. And so what that means is that you're not doing the activities for someone else, you're doing them for you. Or if a third party is conducting those activities, they're being conducted for you. So the IP is controlled by you, the IP arising out of those R&D activities. The expenditure associated with the conduct of those activities is at risk, so no one's paying you to do something for them. And you also need to control the conduct of those R&D activities. So if you're under subcontract to someone and they're telling you exactly what to do and they're paying you for that, then it's likely that they're the claimant rather than you. It's just really important to make sure you have agreements and things in place to be able to demonstrate that. And then there's one final requirement that I'll just explain here, which is particularly relevant probably to a lot of you here today. If you're startup founders coming in on the ground floor, if you are what's deemed an associate, so generally if you have a controlling stake in the company, then any payments to you, so salary and wages or perhaps contract costs, must be paid before they can be claimed. So it's just really good practice to make sure that you pay any salaries and wages and contract costs before the end of the financial year. Otherwise, you'll have to carry those over, and the offset you receive will only be available in the year that they were paid. Now, this slide just kind of illustrates that internally you probably have a project that for the development of a product, process, or service that goes from the initial investigation stage all the way through to commercialization and sales. That is not what an R&D project is. An R&D project is a very specific part of that. You can't include the sales and marketing. You can't include the production and commercialization related to the launch of that product. It's really about the development of the experimental development of that piece of technology in the first instance. I just got a little example here to illustrate. So a project could be Tesla developing the Model X. That's a huge project with a number of, probably hundreds or possibly thousands of individual activities. A smart taxpayer would kind of break that down. Rather than just claiming the whole development, you need to break it down into the core constituent activities and assess whether they are core R&D activities or supporting R&D activities. Supporting R&D activities are just activities that are not in themselves core R&D activities, but are nonetheless required for you to be able to conduct a core R&D activity. And then, so that might be the project management. It might be some, background research. It could be production of prototypes, the actual physical building of prototypes. And so, in this example, the core R&D activity could be the development of new fencing technology, and the supporting activity would be the manufacturing of the keys to test that. That kind of brings me into one of our pro tips. So what you don't want to do generally is claim the whole of the project as a single core R&D activity. It's likely not eligible in that form. Oz Industry have really been looking at this over recent years, and companies often don't sufficiently explain what they're doing, and they have the kind of project objective level hypothesis that we can develop a platform to do X, Y, Z. What you really need to do is drill down, see what the uncertainties are within that whole platform development. So it might be the development of a new machine learning algorithm based on certain principles that, when subject to a specific condition, will provide a desired result at a level of scale, a certain level of accuracy. So it's really important to drill down to that level, and that's where good taxpayers, that's the level that they'll get to. Now, you can have multiple projects in a year. You can have multiple core R&D activities, multiple supporting. That's a bit of a structuring piece to make the claim process efficient, while still sufficiently describing your activities to lessen your chance of any follow-up review or audit activity. Now that I've described some of the requirements at a high level, what do you actually get? What can you claim? So the majority of companies, the main areas of expenditure that they claim are the salary and wages for employees engaged directly in conducting those R&D activities, and also contractors, whether they be external third parties or perhaps internal contractors that are working on those activities. For those ones, it's just always good to have contracts in place that show that there's the control residing with the company, with the claimant entity. There are some other parts. There are some other areas of expenditure: payments to research service providers. You may have purchased materials to construct a prototype. You can generally claim those. You can claim subscription costs to the extent, like software subscriptions, to the extent that they were used or purchased for specifically for conducting R&D activities. And then there might be overheads as well, so rent or electricity for the area of your office that where the R&D team is placed. And there are a number of different calculation methods that can be used for that conducting. I just got a question come through, but there's a bit in there, so thanks, Al. I'll just get to that at the end, because there will be a few other things that will crop up. Now, I didn't mention it directly before, but it's very important to understand that this is a self-assessment program. So what that means is that the receipt of a R&D tax offset, or cash refund, does not necessarily mean that you comply with all aspects of the program. Industry, who administer the program on the technical side, or the ATO, they can come and ask you for further information to substantiate your claims. And if you are unable to provide that, then you may have to pay back monies received. So it's very important that you keep records substantiating everything that you've done. You need to demonstrate that you've taken reasonable care in, establishing that the activities are R&D activities, and that you've made an appropriate calculation. So there's two sides, as I mentioned: Industry to the technical side. So there you'll need documentation to demonstrate what the purpose of the activities were, what the state of the art was at the start of the process, that you've conducted the activities in a systematic way, test results, things like that. On the tax side, on the ATO side, timesheets are pretty important these days, especially when someone is conducting R&D and non-R&D activities. That also flows through to how you account for overheads. Invoices that are sufficiently detailed to show the amount of R&D expenditure, things of that nature. And we can certainly help with that. So there's a few more pro tips here that I've kind of already covered, but I'll just point out the contemporaneous information piece. It's better to have the records produced at the time rather than trying to do that post-fact. That's where companies can get in trouble if they're trying to explain rather than just providing evidence. So evidence, not explanation, is a real key there. If you can just say, the ATO comes and asks you, how did you calculate this? You say, well, here's the invoice, here are the records. At the time that invoice was incurred, we put it in our R&D P&L line item, and this is how it's related. These are the timesheets that clearly demonstrate the actual time spent by each employee on R&D during the year. So that is really the most crucial part. And Al, just to answer your question, so what are the common mistakes startup companies make that cause their claims to be rejected? It is not having the records, not having the documentation to support their claims. You can have the greatest project in the world. You can solve world hunger. You can make something for world peace. But if you cannot demonstrate the purpose of those activities, if you cannot show that you've followed a systematic progression of work, and if you cannot, so I've just got a bit of an alarm somewhere. If you cannot demonstrate that you've followed all aspects of the program, then the ATO and the Oz industry will have no choice but to overturn what you've done. Now, the procedure for claiming is that after the end of the financial year, you fill out an R&D application form. There's a due diligence process there that you should go through. You'll prepare an application that gets lodged with Oz Industry, and that gets processed. You receive a registration number, and that registration number goes in your R&D tax schedule, which is part of your company tax return. The ATO will then process that as part of the normal company tax return process. The great news there as well is that they are processing those quite quickly to help companies deal with the COVID situation. And again, if you'd like more help or have questions, fullstack.com.au/Spark. We have that $500 discount for Spark attendees. Now, there's been quite a lot of movement in the program over the last year or so. I'll just quickly run through. The Morton Resources case was a very welcome decision by the full bench of the federal court, which provides some clarity around what the definition of experimental activities was, and shed some light on site-specific uncertainties. There was a new R&D Tax Incentive integrity framework that was introduced in part to deal with some negative outcomes of the Ombudsman's report into the administration of the program, which was quite scathing regarding the ATO and Oz industry action being conducted. So it has backed off a bit, all that review and audit activity, but I would recommend that companies still do the right thing, that they still keep those records, because it will turn again. There was a bill that was introduced that was going to reduce the rates. That has since been replaced by a very welcome new bill just this month in the 2020 federal budget that announced some new changes. It reversed all the old cuts and actually increased the rates moving forward. So that's great. Those changes are to increase the expenditure threshold from $100 million to $150 to fix the refundable tax offset to the corporate tax rate plus 18.5%. So 18.5% premium. At the moment, for most companies, it's 16%. So that's an increase. For larger companies, they're also increasing the rates and changing the mechanism on how to calculate those. And they are scrapping the proposed $4 million refund cap, which was proposed but never implemented. Importantly as well, these are not going to be retrospective changes. They will be introduced for income years starting 1st of July 2021, and that bill has actually passed in the past week or so. So those changes are locked in, which is great. We were going to talk a bit about forward financing, but I don't think we have enough time. If you want more information, that's effectively a way to obtain financing on future R&D tax offsets, which kind of allows you to increase in the current year your spend. So if you want some more information about that, feel free to contact us on that www.fullstack.com.au/Spark. Now, questions. I've got a few questions. So Al, hopefully I answered your question. I think records, timesheets especially, are crucial, and paying associates before the end of the financial year as well. Paul, if you pay your tech team in equity, how does that work? Is it eligible? Stuart, do you want to answer that one?
Yeah, so they do want it to be matched by cash. So it's not something kind of want to see ASIC actually, you want to see the shares taken up on ASIC by the end of 30th of June, but there'd be need to review quite a few different other circumstances around that as well. So I would definitely take that offline and review it on a case-by-case basis.
Yeah. So our process is generally, if something is in the P&L, then if it's a deduction under the normal the normal provisions, then we can take it out of there and put it in the R&D provisions effectively. But yeah, definitely on a case-by-case basis. So Ian, have you guys heard of startups that have to repay their R&D rebate? How many, roughly what % of startups? So the numbers on that, I'm not quite sure. How many companies get reviewed? So there are those two different. There is the ATO audit process and the Oz Industry Review process, which are two kind of different things. But you may be forced to repay under failing at either of those scenarios. I think it is quite low. It's certainly dropping under the new compliance program that's more education based. So they come before there's a problem, or they try and come before there's a problem and say, hey, look, you haven't demonstrated to us that you have conducted the activity for the purpose of generating new knowledge, for example, and moving on, there might be a problem if you don't fix this. But yeah, certainly companies have, and there have been some quite high-profile cases. There's the Airtasker case, the Commonwealth Bank, although obviously not a startup. But under the kind of old regime, the ATO was actually effectively winding up companies to receive those funds back that had been paid out. How many years back can you claim from Jacoby? So you have you have 10 months. 10 months after the end of your financial year to lodge your R&D application form. So if you miss that deadline, generally you can't claim. So at the moment we're working on 2020 financial year 2020 claims. So you can really only go back 1 year. Yeah, so Andrew Miles correctly points out that sweat equity is not eligible as claimant has not incurred expenditure. Yeah. There may be kind of other ways that you can effectively, do what you want to do, but still be able to claim. There have been, I think there have been a few cases that have gone down that path, but sweat equity is definitely not eligible. So thank you, Andrew, for that. Now. That's all the questions at the moment. So unless anyone has any more, we're about to run out of time anyway. So thank you, everyone. And thank you, Spark, for putting this on. It's been great. I've been tuning in periodically through this week and last week to see the great presentation. So thank you very much for that. And thank you, everyone, for attending today. Again, there's that www.fullstack.com.au/spark if you would like to talk in greater length about anything that we have spoken about today, or even engage us to assist you in this process. Stuart, do you have anything before we wrap up?
No, I don't. Yeah, just thank you, Jack, for presenting, and of course to the team at Spark for putting this together for the innovation community. Yeah, cool. Yeah, thanks for tuning along. There's a lot of other great presenters today. You'll catch it on the live stream. We've got some contact details here as well if you want to reach out too.
Excellent. So Al, just if I have 20 seconds, another common, so with the records, one of the biggest things is establishing what the state of the art was and what the unknowns were. So what the technical and scientific unknowns were based on the knowledge that was already out there. That is one of the key things, along with timesheets, I think, those would be my two main things. Cheers.